Well, good afternoon, everybody, and welcome to this month's Grow Your Law Firm webinar series. The topic this month is on how efficient is your law firm, and I've picked this topic in particular this month because a lot of firms are really looking at this time of year. If they haven't done so already, they should have done this. They're looking at what they're planning and what their budgeting is for the next 12 months. And the work that I do with legal firms, this understanding around efficiency and what it means and what the real drivers are of profitability in a firm, in my view, is quite misunderstood and in some ways not really focused on enough by firms. So I've decided that I'll just put together this month's webinar on the topic and focus on some getting some better understanding around what you need to be focusing on in your firm to ensure that you are efficient and you produce the profits that you desire. So as always, I like to just start with a quick poll and just see who we've got online. So just asking the question there, if you've attended a webinar before, if you could just click yes or no. That's great. We've got some really some good numbers here, and we've got some new attendees that are here today. So 70% of you are new to the webinar. So I need to give my marketing team a pat on the back that we've got a whole pile of new registrations. So look, welcome, and I hope you enjoy the webinar today and take a bit out of it. For everyone that's attending, if you could also just let me know which of these best describes you. Are you a principal or an employed solicitor, CEO, GM, or other? Just so that I can make sure I can tailor more of the discussions around the majority of our listeners today. So thanks for that. So we've got about 56% of the listeners today are principals, with about 16% of also being GMs and CEOs. And for employed solicitors and others, there's still plenty of information in this for you. So thank you for your attendance as well. And lastly, I'm going to ask you this question, but I'm not really expecting you to know what the answer is at this point in time, and hopefully I'll get that clarified for you as we go through. So how efficient is your law firm? This is just what your perception, your view is of how efficient you are. You know, it's very, very subjective. So just give us an idea. Extremely efficient, reasonably efficient, needs quite a bit of improvement, and disastrously inefficient. And it's good to see that we haven't got anybody ticking the disastrously inefficient box just yet. Mind you, we haven't got anybody that's ticking extremely efficient either. So look, thanks for that. So just looking at the results there, about 55% of you are saying that your firm's reasonably efficient. 38% saying needs quite a bit of improvement. But now we've got some disastrously inefficient people. I just wonder whether or not that's just because I mentioned that we didn't have any. But and thanks for those results. But what I'm going to do today is I'm going to challenge you around what I mean by efficient. And as you know, I'm a chartered accountant. So often the measures that I look at when it comes to efficiency is looking at the financial results. And efficiency can mean so many things to so many people. But what I'm going to provide you with today is a context and maybe some benchmarking that you're going to be able to use in your practices to be able to make an assessment as to whether or not you are efficient in terms of producing your profitability. So, as for those of you who haven't listened in before, our focus at FWO Chartered Accountants is to work with our clients around ensuring they're financially well organised. We work with practices, we work with the principals of practices, and we work with solicitors as well in looking after all of their accounting needs as well as guiding them to help them achieve their goals. Where we're focusing on today, though, as part of your financially well organised strategy, is that part of around your business plans. So what are the strategies and actions that you need to be implementing in your business to help drive the profitability and cash flow that will help you achieve your goals? So let's look at what efficiency is. Let's just go to a definition, and no one pulls up the written books anymore. We all just go to the web. And this is the definition I found of efficiency at dictionary.com. It's the state or quality of being efficient, competency and performance. It's accomplishment of or ability to accomplish a job with a minimum expenditure of time and effort. Or thirdly, the ratio of work done or energy developed by a machine, engine, etc. to the energy supplied to it, usually expressed as a percentage. Well, that's great, but how does that apply to a legal firm? How I look at efficiency for a legal firm is to get an understanding of the relationship between the capacity of the firm and the actual revenue that's generated. When I look at firms, and what I usually do when I start working with firms is I do a quick practice review. I do an assessment of looking at their cash flow and profit drivers. And one of those is I do an assessment of their capacity. And that relationship is critical because the capacity of a firm is the amount of revenue that it could possibly generate from the resources that it has employed. So when we look at the capacity, you look at how many people do you have at their charge rates and the hours that they work. If everyone worked at their optimum expectations, then what would that revenue number produce? And then you compare that to your revenue. And what I find in most firms is that the firms that struggle to drive profitability have got a significant gap between their capacity and their revenue. And we're going to explore that in a little bit more detail shortly. But that's what I call efficiency. It's about inputs and outputs. If we look back at these definitions of efficiency, it's looking at how the work gets done, how competent people are in their performance, what's the getting the maximum output for the minimum expenditure, what's the ratio of the work that's actually getting done to the energy that's supplied. So we talk about these things in terms of productivity and workflow and file velocity. But at the end of the day, what we've got to make sure that's happening in the firm is that we've got the right amount of resources producing the right amount of revenue so that we maximize our profitability. So that's what I call efficiency. It's the use of the inputs. It's the use of the inputs around labor. So when you're assessing efficiency in a firm, the critical number, in my view, that you need to be focusing on is this. It's the average dollar rate of revenue earned per hour paid. So in a legal firm, the inputs that we have are basically labour inputs. Our biggest expense by far is labour. And that's both what I call indirect and direct labour. So indirect labour is your overhead cost. It's the receptionist. It's your practice manager. Those are costs that you incur, just like you incur rent. They have a function that they have to perform in the business, but they don't directly undertake activities that specifically drive and create revenue. Indirectly, they do. But from your direct labour perspective, they're your fee earners. Your fee earners have a cost to you, and you pay them for a significant number of hours to perform and produce the outcomes that you need them to do so that you can generate your revenue. So the relationship between the revenue that's generated and the number of hours that you pay for, and then the cost of those hours is critical to measure and monitor so that you're able to maximize your profitability. If we go back and look at that relationship, and I say capacity is basically the number of the maximum amount of revenue that you could generate out of your business if everyone just met their standard expectations around productivity and recovery, working a certain number of hours and so on. So if you break that down, you've got a certain number of hours that actually get that you pay for to produce that revenue. But the revenue is always something very different to capacity. So we need to measure that. We've got to get a really clear handle on that. That's why it's so important, because the focus of creating activities and developing strategies to drive improvement in profitability can only really come from your strategies around the relationship between the price that you charge, or the amount that you bill out, and the cost of that labour. Your overhead's relatively fixed. If you want to generate your revenue, one way of doing that is increasing your number of full-time equivalents. But often that's done in firms that aren't being efficient already, and you should only really be focusing on increasing your FTEs once you've got your efficiency issues worked out. So what I want to put to you now is the concept of gross profit. And most firms don't measure gross profit, and if they do, I don't think they measure it correctly. And for those of you that do, great. If you've listened into other webinars that I've conducted, then you'll know that I talk about this often. And gross profit is the core number, one of the core numbers that you need to be focusing on and measuring at least on a monthly basis in your practice. The reason for this is this gross profit, which I'll show you what it is in a moment. This gross profit is what you earn that covers your overhead, and what's left over after that is what becomes your actual profit. So gross profit is made up of a number of things. First of all, we've got your revenue. Okay, so you've got your revenue that you generate, and it's a block of money. Say it's $500,000, $1 million, $10 million. That revenue then goes to pay for certain costs. The first lot of costs that it pays for is the direct labour costs. And sorry, I'm apologising for being an accountant here, but this is basically how a profit and loss statement is built. So I'm not going to get into the accounting of it, but it's just the concept of why you've got to focus on GP. So direct labour cost is the cost of your fee earners. And what I do when I calculate the cost of direct labour in calculating gross profit, I include the cost of paralegals, but I exclude principals because they generally have a much wider range of activities that they do. So I'm looking at here those direct labour costs being the costs for people that directly and predominantly work on generating revenue, be it working on files, they've got productivity targets. Most paralegals generally do some other things in the firm, but their predominant focus is on assisting the solicitors to get the work done. So the difference between our revenue and our gross profit, and our direct labour, is our gross profit. And from my experience, what I see in firms is the firms that can generate a gross profit that's 75% or more of their revenue, those firms are likely to be the firms that have produced and significantly outperformed the rest of the market in terms of profitability. Those firms that can produce 75% plus of gross profit are the ones that have got their efficiency generally worked out. There's a bunch of other things that they do well, but they fundamentally have this efficiency work well. But in saying that, there are other factors that you can have a firm that's producing a really good gross profit of, say, 75-80%, but it might mean that the principals are charging way too much time, and then the other fee earners aren't, and that can also produce that number. So you've got to look at these numbers in context of understanding, what actually drives them. The next thing is the overhead. So what then comes out of your gross profit is all of your other costs. So your premises, your IT, your indirect labour, electricity and phone and all of those different costs. And what you've got left after your overhead is your net profit. So if you looked at all of your costs in your practice, your overhead is relatively fixed. There's nothing much that you can really do on an annual basis that really trims that down to produce a significant impact in profit. We like to, you like to run practices off the smell of an oily rag, so we control our overheads. But where we don't get the benefit of driving profitability is in how we manage our GP. And our gross profit is by far the most critical element and the most critical number that we've got to focus on activities to improve. So what we're going to spend some time now is looking at this concept of an efficiency factor. We're going to look at the concept of the relationship between revenue and the relationship between capacity. And I'm going to show you a simple formula that I use when I look to make a first line assessment of how efficient a practice is. And then from there, you've got to delve into it. You just can't take this at face value. You've then got to go and look at what the makeup of it is. But it's this concept of an efficiency factor. And basically, all efficiency is takes your actual revenue as a percentage of your capacity. And I'll show you the calculations of this soon and give you some examples. But when you have a look at how efficient a practice is, you've got to understand this relationship. Because if you've got a whole pile of hours that are able to be charged out to clients that aren't getting charged out to clients, your efficiency factor is going to be lower. If you've got a whole pile of if all of your capacity or hours are charged out to clients and billed, then you're going to have a much more efficient practice. But as I said, it's the first baseline assessment that you make to determine, how much further you've got to dig, or to identify whether or not you've got some efficiency issues. So just think about that in terms of your own practice. Think about that in terms of how many people you've got and what your capacity is for generating revenue. And ask you a question if you've ever done that before. It's a very worthwhile exercise just to take some time out and assess that. And then compare that to your actual revenue. And this is what I've found. I've found that firms where their actual revenue is more than their capacity are very efficient. It means, and I'm not talking necessarily here around file velocity. What I'm talking here about is their usage of the hours that they're paying for in relation to the revenue that they're generating. So the efficiency of those hours in terms of revenue generation is pretty good, but they won't have any capacity for growth. And what you've then got to look at is you've got to have a look deeper into that to assess whether or not there are any other issues in those firms. But just from the usage of labour, I consider them efficient. If you've got a firm that's 90 to 100%, I think that those firms are very efficient, but they've limited capacity for growth. So if you're running it close to 100%, then you're really much the same as the first category. You haven't really got an opportunity to grow significantly there in terms of your revenue, just from a production perspective. If you're closer to 90%, you've got some capacity. Firms that land in the 75 to 90% range, so that their actual revenue compared to the capacity to generate revenue is in that 75 to 90%, their efficiency gains that they can make. So they've usually got good opportunity of driving strategies around improving productivity and write-ons or write-offs, focusing on good file velocity strategies. But depending on what those other key performance indicators or those other key numbers are, they may also need to consider reducing their fee earner labour costs. It might be that they're carrying too many people, depending on the work. there are other things. They might not be pricing correctly. So, there might be an opportunity to increase their revenue purely from better pricing and sales strategies. But then there are a lot of firms that fall into this category, and that is they have an efficiency factor of less than 75%. And fundamentally, they're only generating uh, less than three quarters of the capacity. So less than three quarters of the hours that they physically pay for, they're not generating enough revenue out of them. And those firms usually are quite inefficient. Often they need a bit of an overhaul, but they just really need to get focused on the key drivers of profitability to turn those numbers around. And more often than not, they need to reduce their fee earner labour cost. They're just usually carrying too many people. And often that's often due to just old practices that continue to exist that have been carried forward and, um, and done for a long time. Often in terms of the ratios of paralegals or secretaries to principals, or paralegals and secretaries to um, solicitors. It's also quite relevant for firms that have got a high level of partner or principal productivity, but have got very low levels of producer or fee earner productivity. So they're paying for a whole pile of costs, but not generating as much revenue as they should be. So what you should do in your firm is actually do those calculations and use this as a bit of a guide. Sit down and list out your fee earners and what your expectations for them are around their productivity and charge rates and so on. And then compare that to your actual revenue. But use this, as I said before, as a guide. It's your baseline number. It's your first run review. It'll say to you, well, okay, I've got a bit of an issue, or I don't have a bit of an issue. You've then got to go and dig deeper to really understand exactly what the drivers are around your efficiency. So it's these other KPIs that you focus on. So you may have, if you've got opportunities there for improving your efficiency factor, then it might be a strategy around productivity. Productivity is basically a number of hours charged in a day divided by the hours available to charge. I continuously have this debate with principals of firms around what that right number is. And maybe I should do a poll of this in one of my future webinars to get an idea of what the expectations are across the industry on what the expectation is around charged hours. Often I have this conversation saying they say that look, it should be about 5 hours. And look, I just don't buy it. I look at if you've got producers and you've got a firm that's efficiently running, that's saying that 2/3 of their time they just need to charge to clients. The other 1/3 you're not getting any revenue out of, and that 1/3 effectively, if you look at say a 5-day week, that's 1 and 2/3 days. Heading towards 2 full days that you're paying someone not to charge. It's very, very difficult to generate have a good profitable practice if you've only got expectations of charged hours of fee earners around 5. It should be a fair bit higher. So productivity can improve that, so getting more charged hours. That. In terms of write-ons and write-offs, so you can have strategies that get built around how you price. Once it gets into WIP, you need to bill it. We've talked at different times in these webinars about the importance of how you engage your clients. It's the key strategy at the front end, how you engage your clients around driving write-ons and write-offs. In one of my current FWO Growth Club groups, we had our our quarterly webinar catch up yesterday that runs in between our full day workshops. And some of the strategies, the action plans that some of the firms needed to implement were around this engagement. And getting better at that engagement process at the front end, and also what some of them have done, had upped their charge rates by a significant amount. And then because of the engagement, they've been billing, they've reduced their write-offs, and in doing that, they're going to drive better profitability. And then also your average charge rate. That's a really important. So this is the average of all the hours that have actually been charged to work in progress. Really important one to look at there. And you've got to have a look at the mix of it. Because if your average charge rate that is actually being achieved is higher than your average rate that from a capacity perspective, often that will mean that you've got a wrong weighting, meaning that your principals will be charging a lot more at their higher rates, and your other fee earners won't be achieving their productivity targets. So whilst that might look good as an increase in average charge rate, as a business, it indicates that you've got a couple of other things that you need to look at. So when I say, going back to this, using these as your headline numbers, the efficiency factor numbers, using those as your headline numbers to see whether or not you've got some opportunity there, or you've got to make some decisions around activities and numbers. These are then the other core KPIs that, as a starting point, you need to go and assess. So yeah, don't just jump to the conclusion, drill down a little bit further. So let's put this to some numbers. So what I've got on the screen here in front of you now is just some core data. So we're going to go and have a look at how you might go about assessing this in your practice. So basically, I've got a capacity calculator here. This is just a simple tool that I use when I go into practices. I do an assessment of how much revenue they can generate. So just heading across the top there, we've got full-time equivalent. So in this firm, there's 4.4 full-time equivalent fee earners. We've got, out of those hours that they actually work, the target number of hours. And so in this particular practice, the average productivity is 73.76%. The charge rates for those fee earners, the number of hours available. So you see there that I use 1672 hours, but where you've got less than a full-time equivalent, those numbers are a bit less, which then, when you multiply their productivity percentages or their hours targets by the available hours, gives the charged hours multiplied by their charge rate. So in this firm, there's about 1.126%. So I'm just showing you that because I'm going to now throw into a calculator that then you can apply the principles of assessing your efficiency in your firm. So just from that data, if we have a look at this particular firm, we've assessed that it's got 4.4 fee earners. And what I've already got in the middle column here is, for this particular firm, some numbers. So I've already gone and put their actual revenue numbers in here. And it shows that they've got a gross profit of 65%. They've got write-offs of 11%. Their average rate that they're charging is $242, but their productivity is running at about 51.22. Now that number of around 50%, in a lot of practices, is a very normal number. Look, it's way too low. It's incredibly inefficient, and that's what this is going to show you. But that number I see jumping up so often, 50 to 55% in terms of average productivity. That's what's happening out there. There's massive upside that's to be made in terms of focusing on strategies in your firm to drive improvement around efficiency. So in this firm, we had a capacity of 63.76. That was just taken from that data that I previously had up. So that produces capacity charged hours of 4,691, which is 923 hours that didn't actually get charged in that particular year. Productivity running at 63.76, which is still, for a firm, I think, quite low. Their actual ended up being 12.5% less. And the average charge rate from those other numbers that I had up was 240. So for this particular firm, it had a capacity of 1.125 million. but it only billed out and generated revenue in that year of $811,000. So there was $314,000 of capacity or potential revenue if all of the stars aligned and everyone hit their targets, that could have been generated. So if we look down below, we can see, so you can see that efficiency factor has already been calculated there. So it's running in this firm at 72.9%. So that then fell in this particular firm, fell down below that less than 75% efficiency. So this firm, it highlights for them what the issues are that they've got to address. Well, firstly, if we look at those numbers, we've got a productivity issue. So we've got to stop and sit down and assess for our team members and across the board, including principals, how this revenue is being generated. Who is running at what productivity number, and then what are going to be the activities around improving that? Is it that we don't have enough work? Is it that we've got enough work but we're not focusing on driving our file velocity through? Is it that we're looking at we've got some inefficient administration systems, meaning that the fee earners are spending too much time doing non-chargeable, non-productive work, making those strategies. Then looking at the average rate. So in this instance, our average rate of revenue is a little bit higher than our average rate on our capacity. For me, as I said before, that's an indicator that you've got higher principal productivity numbers and lower non-principal fee earner productivity numbers. And we've also got a write-off there of 11% compared to a capacity of 0. That by itself shows me a few things. That one of the things I'd look at there is around the engagement and pricing policy at the front end. How clients are engaged, because often I see that most bad debts are written off in firms prior to the bills even being issued to clients, and that's what a write-off is in my view. You've done the work, you've logged it into work in progress, but you don't bill it to the clients. And so you're just writing that revenue off, you're taking it off the table. So a combination of the work of hours not being charged and not then being billed has resulted in a lower revenue target for this year. And if we just pop in the same cost for direct labour, then it produces a potential gross profit that we could have earned of 74%, pretty close to that 75% number that I mentioned before. But if our productivity targets were actually higher, then and the business is structured in a way that allows those productivity targets to be more. So if for example, this capacity target was 70%, then you can see that it drives our gross profit even higher, and then into those ranges of the high-performing firms that are 75% plus. But I'll just put that number back in there. So if you then have an analysis of that average rate, so if you can remember what I discussed earlier was the critical number is the revenue that's generated per hour that we pay for. And the hours that we pay for are these available hours. We pay those available hours regardless of whether or not the fee earner is charging time or not. So our average rate there has a capacity of 153, but we're only achieving 110. So for this particular firm, there's $43 of potential revenue that is being left on the table. And if we're looking at that as a percentage of the 110 that's actually being charged, is that there's an opportunity there within this firm to generate an additional 39% revenue increase from that average rate. If we then break that down a little bit further and we divided the cost of that labour by the cost of the labour that we're physically paying for, so included in there is some principals, and I haven't got that number there, but the rate per hour when you compare to the rate per hour of what you physically pay against the rate per hour of what you're generating, that actually then produces for you a gross profit of a rate per hour. And it'll be a very interesting number to assess. But I hope you get the picture here that when you're building your strategy in your firm, you've got to break these numbers down and assess them and bring it back then to strategies and then the key drivers of what's going to make the difference. And then what you do is you develop and implement your strategies that are around achieving this improvement in efficiency, achieving more revenue that you're generating per physical hour that you're paying. So that's what your numbers look like. And look, the reality is that in firms there are heaps of factors that impact on efficiency for a legal firm, and it's going to be different for every single firm. Those can be impacted by the volume of work that you produce, that you've got in the practice, the number of fee earners, the pricing, your pricing models, the experience of fee earners, the systems or lack thereof. So there's a whole, and look, there's hundreds of more reasons. But what you've then got to look at is what are the activities you've got to drive within your practice, one activity at a time, to improve these key variables that impact on those numbers. So I just want to do another little poll now. I'd be really interested just to see what you'd expect the efficiency factor to be in your firm. You know, what do you think that might be? Is your firm less than 75, or are you in the 75 to 90? Are you really efficient? Because if you think about it from a raw materials perspective, if you're in a factory, you know, having hours that you're paying for that you're not actually billing out to clients, then that's like buying a whole pile of plastic that you need to turn into bottles, but throwing out 25, 30, 40% of it. You're not going to be able to generate a profitable unit that you can then go and sell. So if I'll just close that poll down now and show you the results, that of the attendees that are listening today, the expectation there is that 70% roughly of you expect that your efficiency factor is less than 75%. And you might, I don't want you to go out and get too miserable about that. What that tells me is that you've got an opportunity there to significantly turn around the profitability of your practice simply by taking action in the areas of what you do around driving efficiency. One of those might be around file velocity, but it's really about driving the activities that improve specific numbers. And then another 30% of you have an expectation that you're in that reasonably efficient sort of area. There's 75 to 90%. You might need to consider whether or not whether you've got too many employees, or you might need to consider sort of the mix of the work that people do. But there's a whole bunch of actions that you can take to actually drive the outcomes of improving that profitability. So look, thank you very much for that impact. Now, in understanding that that's basically what your outcomes are that you need to be focusing on, I just want to recap. And I encourage all of you to actually go and physically do this calculation. Get a picture of what you think your efficiency factor might be. Then once you've got that, you can drill down into the core drivers around that output, so that you can then assess what are the areas you need to focus on, so that you can drive up that efficiency factor. As I said, what I do with firms is I focus very much on getting a clear picture of their efficiency to start with, because it tells me a lot of stories around what's going on in a firm, particularly around the relationships between principals and fee earners and the outputs that are being produced. So as always with my webinars, I'm offering for the first 15 today to email me a free 45-minute online meeting to assess your firm's efficiency. what we'll do in that meeting is I'll get you to just provide me with some high-level information that will tell me a few stories. We'll put that into that calculator for you. And then from there, we'll have a 45-minute conversation around what's happening in your practice and what your thoughts are, and answer any questions that you might have. Absolutely free of charge, and absolutely no requirement to go any further than that. But hopefully what it does for you is that it starts you down the path of focusing on efficiency in your practice. It starts you down the path of working out what those steps are that you need to do to get a different result. Albert Einstein defines insanity as doing the same thing over and over again and expecting a different result. So I'm encouraging you not to be insane. So please take me up on that offer. Just email me at matt@fwo.net.au, and we'll schedule in a meeting and get that little checklist of information off to you, which won't take you too much time to prepare. Our next webinar is on the 21st of August 2013 at 12 noon. And in that webinar, we're going to be talking about understanding pricing. So as I said, I base my webinars on what I see and come across with the firms that I work with. And what I get, I very much have a strong view that the understanding of pricing in legal firms has got a bit of work to do. So what we're going to run through in that webinar are understanding the impact of discounting and pricing too little compared to actually having strategies where you increase your price, and the impact that has on volume, on how many transactions you've got to do, how many matters that you've got to actually do. Also, the impact that it has on developing your pricing strategies around charge rates, and what you need to be doing around ensuring that you're being scientific about that. A lot of firms just pluck a number out of the air. But once again, the structure of that will drive the outcomes. So I'll give you some insight into some calculations you can use. But also we're going to cover off looking at, from a pricing perspective, what you need to be focusing on primarily when it comes to pricing work for clients. And I'm going to hopefully allay some of your fears and concerns around what works and what doesn't work. Just going back to my FWA Growth Club webinar that I had yesterday, one of the activities from one of the members projects was to go and implement a standard price increase. It was about 10 or 15% on average over all of their standard prices for some of their products in their services that they provide. And I asked they went and did it the next day. And I said, well, what's the impact? He said, nothing. In fact, their inquiry rate had increased, and their conversion rate of new work had increased without any query at all on the price. So there's a few myths there that I'd really like to address with you. So you're able to register now for that webinar at financiallywellorganised.com. As always, we'll be sending out to you invitations for that webinar prior to it happening next month. And also, please don't forget to take a look at our website. We've outlined some of the other services that we provide there. We provide an annual accounting service to all of our clients, which is quite unique in that it's fixed fee, unlimited telephone calls and emails, and paid over 12 monthly instalments, and covers off all of our clients' accounting and compliance needs. We've got clients all over the eastern seaboard that work with us in that regard. So we're very keen to look at seeing whether or not we can help you out in terms of your compliance needs as well, because we are ultimately, fundamentally, a chartered accounting firm. We also encourage you, if you haven't done so, to register at our website for the FWO Legal Firm membership. There's a number of benefits that you get from that. A bi-monthly exclusive legal industry magazine that we prepare, early bird registrations for webinars, personalised invitations for other workshops, and a free one-on-one profit and cash flow improvement review of your firm. And you can call me at any time and ask or email me and ask me any questions. Also, we have our FWO Growth Club, which is designed for 1 to 3 principal size firms, where over a 12-month period we get you working with like-minded and similar size practices to help you drive and implement strategies around improving your profitability. Our next FWO Growth Club that we're running is penciled in for starting in late August in Sydney, and our next Brisbane Growth Club will be commencing in November. So to register your interest for that, or if you would like to get some more information, just email me at matt@fwo.net.au, and we'll schedule in a time to catch up and talk further about that. So once again, thank you very much for your attendance today. I really appreciate your support and your commitment to our FWO Grow Your Law Firm webinar series. For those of you who are joining us for the first time, thank you. I really hope you've enjoyed the webinar today, and I encourage you to come back next month and participate. For all our frequent flyers, thank you very much for attending again today. And as always, if you want to get a different result, you need to do something different. So please make a change in your firm, and please drive your strategy so that you produce a different result. So thank you very much. See you next month.